Octopus Renewable Energy is paying over 10% dividend right now, while many of their competitors are cutting theirs. Looks like a trap, right? At least that's what the market seems to think. Because the company is currently trading at a massive 38% discount to its asset value. But here is where it gets interesting. Because while investors are dumping the stock, institutions are buying its asset at full price. Not at a discount, not at a fire sale. Full value. So today I'll break down what's really going on and whether this is a hidden opportunity or a value trap in disguise. And if you're new here, my name is Florian and I'm a physics engineer from Germany with a passion for data-driven and objective investing. Welcome to the channel and thank you for joining me today. When we look at the UK renewable sector right now, we see a sea of distressed companies. Trusts are cutting their dividends, breaching debt contracts and changing business models. But ORIT seems to be the outlier. It's one of only a few major trusts in this space that still has a working business model and a decent dividend cover, and could even increase their dividend payments slightly this year. In contrast to many other trusts, they try to build a diversified portfolio over different technologies like solar as well as on- and offshore wind. But the most important number isn't the admittedly pretty impressive dividend yield of currently 10.3%. It's the 1.14 times dividend cover. This may not sound high, but compared to many other of their peers, it is actually okay. But this has not protected the stock, which is down by almost 50% in the last 4 years. Now, the whole UK renewable sector is currently struggling with an increasing discount to the NAV, the net asset value. And for ORIT, this discount is currently at 37%. I will talk about the exact reasons why this is later. But while skeptics will tell you that this discount is justified, the truth is that ORIT did sell some of their assets on the market. And they sold all of them at or even above their net asset value. So while their shares are trading at a discount, the trust itself still manages to sell their assets at a fair value on the private market. That is concrete evidence that institutional buyers still think that these assets are worth their value, while the stock market is trying to sell them at an almost 40% discount. And while their peers are struggling with the rising interest rates, ORIT has used the money from these sales to reduce their gearing, their debt level, and at the same time also the cost of their debt. While the cost of debt was still 4% last year, they managed to reduce it to 3.3% now. So they aren't just managing through this environment, they are preparing the balance sheet for a crisis. The market is also pretty terrified that the current bank rate in England will go higher. But in their last meeting in March, the committee kept it stable. And a recent poll from Reuters that just finished earlier this week also indicates that despite the inflation pressure from the war in Iran, the interest rates might be kept stable throughout the year. Now, of course, this depends on how the situation in Iran and the Strait of Hormuz develops from here. But on the other hand, renewable energy trusts could also be one of the biggest beneficiaries of higher power prices. This is because the energy prices in the UK are linked to the most expensive providers. And most of the time, that comes from burning gas. So when the war in Iran sent gas prices up, the price for the whole industry rises with it. Now, for ORIT, this is unfortunately not too relevant, and I'll explain why in a second. But before I do, you might have heard about the UK's government's move this month to decouple gas and electricity prices. The bears love this because they will tell you that this will kill the war premium for renewables. But they are missing two critical facts. First, Octopus Renewables is a European trust. They aren't just betting on the UK grid. They have major operations in Ireland, France and Finland, countries where the gas-linked pricing is still very much alive. And second and more importantly, 88% of ORIT's revenue is already fixed for the next 2 years. They have already locked in the prices we've seen over the last 18 months. So even if the UK's new policy is a total success, it barely touches ORIT's bottom line in the short term. But of course, this is also the exact reason why they can't directly benefit from higher gas prices. And I say directly here, because half of their revenue is linked to inflation over the next 10 years. So while the higher gas prices do not have a direct impact on them, a rise in inflation that might be caused by this would still have. But if ORIT's operations are so stable and not affected by interest rates or energy prices, why is it still trading at a discount? Why aren't investors piling in? To be fair, the market has some very logical reasons to be afraid because the NAV is impacted by various factors. And while ORIT has fixed and secured most of their revenue against fluctuation in the power price, bears are still worried that if the wind is blowing and the sun is shining, there is so much clean energy produced that the price crashes to zero, which definitely would have an impact on their cash flows. And they even specifically had this problem with the Ballymacareny complex, one of the largest solar complexes in Ireland with 274 megawatts. The part that you see here is just one farm of many that make up the whole complex. But if we look at the annual report from 2024, we see that the site had a 60% downtime due to restrictions in the energy grid or market conditions, which essentially just means that they did produce energy but could not sell it. So this revenue was lost completely. But the grid fix is at least already funded. The Irish regulators just approved a record 80.9 billion euros to modernize the national grid through to 2030. This is specifically designed to end such curtailments. And there is also discussion in the European Supreme Court going on that electricity providers might be compensated for such restrictions by the grid. But this is still in discussion. Another risk is the gearing. While ORIT did manage to lower their cost of debt, their gearing is still at roughly 45% of their GAV, their gross asset value, which is higher than their long-term target of 40%. And compared to the NAV, which also includes the debt, the gearing is even at 92%. This is even slightly higher than the peer average, so ORIT is still carrying a lot of debt, which of course increases their risk. And we still need to see if they really managed to reduce it to the target level. And finally, the whole renewables infrastructure sector is under pressure, and ORIT is currently being punished to be part of it. But look at the orange line here. The development of the net asset value returns. For ORIT, it is still generally increasing, while some of their peers like Next Energy Solar or Greencoat UK Wind are struggling to keep it even stable. This is important because it measures the performance of the underlying assets rather than the stock price. And if it is still increasing, it basically shows that the assets are still doing good while the market is just refusing to price them fairly. But it at least shows that the business model is still working. Now, if you're tired of surface level and hype driven stock videos and feel like this kind of analysis helps your own investing, please hit the like button and subscribe to the channel to not miss my next one. As a small channel, every single like and subscribe goes a long way, so thank you very much. Now, when we take a look at the numbers, we see that in 2025, the NAV declined and they also had a negative NAV total return. But this came from the asset sales that they did and which are and will be reinvested in growth. Their revenue was also not hit by this decline yet. Their EBITDA did decline a bit, but this was due to the re-evaluation of some of their assets. Their operational EBITDA was actually up by around 3%. Now, late last year, they also updated their strategic goals for 2030. And they state explicitly here that they are aiming to grow the NAV and scale the company. They also want to increase the share of construction assets compared to operating assets slightly. These are more risky, but also come with potential higher returns. At the same time, they are still aiming to lower their gearing to 40% of the GAV and target to return around 10% to their shareholders. This includes dividends, share buybacks, as well as price returns. Now, this sounds nice, but when we consider that the current dividend yield is already at around 10%, I feel like this is a safe bet rather than an ambitious goal. But I mean, with 10% average annual returns, you would still beat the long-term performance of the MSCI World. And in general, I feel like this is achievable. Especially when we also consider their weighted remaining asset life of almost 30 years. This is the duration where the assets are still expected to produce returns until they need to be replaced or decommissioned. So it's still a pretty long lifetime and they are actively trying to replace older assets with newer ones to keep it that way. If you are familiar with these kinds of investment trusts, you probably know already that similar to ETFs, you have to pay a fee to the management team. For ORIT, this fee was 1.22% of the average net asset values. So it was completely linked to the assets, not the stock price. But late last year, they moved to a 50-50 fee structure based on both net asset value and market capitalization. And this is a critical distinction, because it means that if the share price stays at a 38% discount, the managers take a direct pay cut. So they are now financially incentivized to close the NAV discount of the stock price and not just to grow the fund. Of course, we still need to wait to see if they really manage to do this. But at least they have a slight motivation push to do so, if you will. So overall, I think that ORIT looks like a pretty decent investment right now. They have a 10% yield that they could even grow this year in contrast to some of their peers, and it is also still covered, although not by a very wide margin. They could also keep growing the NAV total return and are still planning to grow it even further until 2030. But their gearing is one of the highest in the industries, and the investor sentiment for the whole sector is also not so great right now. So while I think that they are definitely worth a second look for investors who are looking for a passive income, for me, they are still a pass. But as always, that's just my opinion. Now, I would like to hear from you. What do you think about ORIT and renewable energy funds in general? Let me know down in the comments. And if you're now interested in 9 companies with a much more stable business model and with lower debt that are on their way to become the next dividend aristocrats by 2035, watch this video next. And as always, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.